So what if the exact strategy that made you wealthy in your 40s is like the exact thing that ends up bankrupting you in your 70s?
Oh man, it's just a brutal realization for high net worth retirees
Yeah.
because you spend decades, right? Decades deferring taxes, maxing out your accounts, and just feeling incredibly smart about your whole accumulation
You
strategy.
feel like you won the game.
Exactly. But the tax code actually has a trap door
Right.
just waiting for all those pre-tax accounts during decumulation.
Which is terrifying.
Yeah.
And today we're looking at this hidden 10-year window where you can actually defuse that time bomb, right?
Yes.
So we are jumping into a deep dive today on a really comprehensive guide from Davies Wealth Management.
Hmm.
They are a fee-based fiduciary advisor located over in Stuart, Florida. And this specific material, it comes from their 1715 Treasure Coast Financial Wellness platform.
It's a great piece.
Yeah, specifically, we're exploring their guide called Roth Conversion, 7 Critical Reasons Ages 62 to 72 Matter. So our mission today is really to decode why this exact decade is the most high-stakes financial period of your life.
Yeah, and how to protect your wealth from all these hidden tax tripwires.
Yeah.
Because the core premise here, it kind of defies conventional wisdom, doesn't it?
It totally does, because you think, okay, I stop working, my taxes go down.
Right. When you finally stop working, you just naturally assume your tax burden plummets because, well, your executive salary or your business income is just gone.
You're not getting that massive W-2 anymore.
Exactly. But for highly successful savers, that drop is an illusion. I mean, it's merely a temporary valley before a massive forced tax spike.
Okay, let's unpack this income valley concept, because understanding the terrain is really step one here.
Sure.
So you hit age 62, right? Your high-earning corporate or business income wraps up, and you are holding off on Social Security until maybe 67 or 70 to, maximize those monthly benefits.
Which is the smart play, usually.
Right. So suddenly your taxable income basically flatlines. Like you might be living off cash reserves or capital gains, but your ordinary income is, it's negligible.
Yeah, you are sitting in the lowest tax bracket you've probably seen since, your first job out of college.
Oh, wow, yeah.
But that valley has a sheer cliff right at the end of it.
A cliff being age 73.
Exactly. At age 73, the IRS steps in because the government isn't forcing required minimum distributions or RMDs to, help you manage your money better.
Right. They aren't your financial planner.
No, not at all. They have been letting you defer taxes for 40 years, and at 73, their patience officially runs out. I mean, they want their cut.
They literally force you to withdraw your own money, right? Like whether you actually need the cash to live on or not.
Oh, absolutely.
Yeah.
The IRS dictates a specific percentage you must withdraw from your traditional IRAs and pre-tax 401k accounts every single year.
Wow.
And it's based on your age and the remaining account balance. And every single dollar of that forced withdrawal is taxed as ordinary income.
So it doesn't get favorable capital gains treatment or anything?
Nope. It is taxed as if you basically went back to work and earned a salary.
That is wild. The Davies Guide actually walks through a scenario that makes the math it's terrifyingly real.
The $3 million example, right?
Yeah, exactly. So take a successful executive who hits retirement with a $3 million pre-tax 401k. At age 73, that first forced RMD is roughly $116,000.
Which is already a lot.
Right. But here's the kicker. That account is ideally still growing in the market, right?
Hopefully, yeah.
So by the time you're 80, even with those mandatory withdrawals, the account balance has likely grown, which pushes that forced annual withdrawal past $200,000.
Yeah, and you have to add that $200,000 to your now fully taxable Social Security benefits.
Right.
Plus maybe a corporate pension, plus all your other investment income. So you haven't just lost your low tax rate during that valley.
You've been rocketed right back into the highest marginal tax brackets.
Entirely against your will.
It's okay, think of it like this. It's like you've spent your entire career successfully dodging heavy traffic, right?
I like this.
You took the smart back roads, you deferred your taxes, navigated the whole journey beautifully.
Right.
Then you cross the retirement finish line at 62, coast for a bit on the open road, only to hit age 73 and realize all those cars you dodged for 40 years, they were just parked, waiting for you in a massive, unavoidable traffic jam right at the exit ramp.
That is a brilliant analogy because the deferred tax strategy works flawlessly for building the wealth.
Right.
But in retirement, those massive balances actually become compounding liabilities.
Yeah.
The larger your success was in your 40s and 50s, the harder the IRS hits you in your
So
70s.
you basically just delayed the traffic jam to a point in your life where you have like zero control over the steering wheel.
Exactly. And the IRS hitting you with ordinary income tax is honestly just the first domino.
Wait, really? There's more.
Oh, yeah. Because these forced RMDs trigger a completely different trapdoor that most people don't even know exists.
Okay, we need to get into this. This is IRMAA. Right?
Yes, IRMA. This is the stealth penalty that catches almost everyone off guard. So IRMAA stands for the Income-Related Monthly Adjustment Amount.
Okay.
It basically functions as a strict Medicare means test.
Oh, okay.
When you hit certain income thresholds, the government starts slapping massive surcharges onto your Medicare Part B and Part D premiums.
But the really insidious part here, and I have to push back on the sheer logic of this, honestly, is how they calculate it.
Oh, the look-back period.
Yeah, the guide points out they use a 2-year look back. So they are looking at your modified adjusted gross income, your MGI, from 2 years ago to determine what you pay for healthcare today.
Exactly.
So you are 75, getting hit with premium hikes because of a forced RMD from when you were 73. I mean, it feels like you are being heavily penalized simply for being a disciplined saver. How is anyone supposed to see that coming?
It's tough. The administrative reality behind that 2-year lag is really just the time it takes for the IRS to process your tax returns and sync that data over to the Social Security Administration.
Right, because they handle the Medicare premium.
Exactly. But the real-world impact is exactly what you described. It's the delayed reaction penalty. Your forced RMDs spike your income, and 2 years later, you and your spouse are suddenly paying 2, 3, or even 4 times more for the exact same Medicare coverage as the person living right next door.
Wow. And because those RMDs happen every single year and usually grow as you age, that surcharge isn't just a one-time fine, is it?
No, not at all. It becomes a permanent, bleeding fixture of your retirement budget.
That is brutal.
Which is why understanding MAGI is absolutely critical here. MAGI isn't just your standard taxable income.
Right.
It's the IRS pulling out a magnifying glass and adding back in things you thought were safe.
Like what?
Like tax-exempt municipal bond interest, for example.
Mm-hmm.
They add that back in to see how much money you really have flowing in. It is very, very hard to hide wealth from the MGI calculation.
Unless you use a Roth IRA.
Ah, yes.
The Davies Wealth Management material really hammers this point. So why does Roth money suddenly solve a Medicare IRMAA problem?
Well, under current tax law, qualified distributions from a Roth IRA are completely excluded from your MAGI.
Oh, wow.
Yeah, they are entirely invisible to the IRMAA calculation.
Invisible. Okay.
So if you are forced to pull $100,000 out of a traditional IRA, your MAGI goes up by $100,000, which potentially triggers several tiers of those Medicare surcharges.
Right.
But if you pull $100,000 out of a Roth, your MGI doesn't move a single cent. It shields you from both the ordinary income tax and the stealth healthcare penalty.
Okay, so the ultimate goal here is clearly to get the money out of the pre-tax traditional accounts and into the Roth before those age 73 RMDs begin.
Precisely.
But you can't just take a $3 million IRA and, like, convert it all on a random Tuesday, right? The tax bill for executing a lump sum conversion like that would instantly push you into the top 37% bracket.
Doing it all at once would be financial self-sabotage.
Right.
You would lose an enormous chunk of your principal to the IRS overnight. The objective is to move the money efficiently, which is exactly where that 10-year window from 62 to 72 becomes so critical.
Okay, here's where it gets really interesting. The strategy outlined here is called bracket filling. And I was trying to conceptualize this, and it feels a lot like playing a game of Tetris with your taxes.
Tetris?
Yeah, think about it. You have this specific amount of space in a row, like your current low tax bracket during the income valley.
Okay, I'm with you.
And you want to drop the blocks in perfectly so they fill the row, but you absolutely do not want them to stack up into the danger zone of the higher brackets at the top of the screen.
The Tetris analogy is actually perfect because the penalty for stacking too high is immediate.
Right.
So during your income valley, you might be sitting comfortably in, let's say, the 24% tax bracket.
Okay.
You look at your baseline income and you calculate that you have exactly $80,000 of room left before your income tips over into the 32% or 37% bracket.
Got it.
So you strategically choose to convert exactly $80,000 from your traditional IRA to your Roth.
So you are volunteering to write a check to the IRS today for that 24% tax.
Exactly. You are paying taxes you don't strictly owe yet.
Which feels completely contrary to human nature.
Oh, totally. People hate writing checks to the IRS. But mathematically, you are paying 24% today to permanently inoculate that money against the 37% bracket later.
No.
and against the IRA surcharges, and honestly, against any future legislative tax hikes.
That makes so much sense.
And there's a crucial detail here. You really should pay that 24% tax from your outside cash reserves, not from the IRA itself.
Wait, really? Why?
Because if you withhold the tax from the conversion amount, you are permanently shrinking the capital that actually gets to grow tax-free in the Roth.
Ah, right. You want the maximum amount of money crossing the border into the Roth.
Exactly.
And you don't just do this once. The guide refers to this as a Roth conversion ladder.
Right.
So you basically execute this bracket-filling Tetris strategy every year for the entire decade between 62 and 72.
Yes.
And by the time the IRS comes knocking for those mandatory withdrawals at 73, you've methodically moved $1 million or more completely out of their reach.
It is a controlled, systematic demolition of your pre-tax accounts. You are draining the liability at a known discounted rate.
Right.
When age 73 rolls around, your traditional IRA balance is much smaller, meaning your forced RMDs are totally manageable. Your taxes stay low, and your Medicare premiums remain right at the baseline.
That's incredible.
And meanwhile, you have this massive compounding Roth account generating tax-free growth for the rest of your life.
But, and this is a big but, even if you are executing this Tetris strategy perfectly at the federal tax level, you could still lose like half your gains if you aren't paying attention to the other pieces on the board.
That's right.
The 1715 Treasure Coast Financial Wellness Material makes it very clear that conversions aren't just a universal hammer, right?
No, definitely not.
There are hidden tripwires where converting actually destroys wealth.
The most dangerous tripwire for affluent retirees is the net investment income tax, or NIT.
Okay, what is that?
It's an additional 3.8% tax levied on passive investment income. So things like capital gains, dividends, rental income. But it only kicks in when your NGI crosses specific, really rigid thresholds.
Let me guess, a sloppy Roth conversion inflates your MGI and shoves you right over that exact threshold.
Right into the penalty box, yes.
Ouch.
You might think you're just paying your 24% on the conversion amount, but you inadvertently triggered an extra 3.8% tax on your entire separate portfolio of investment income.
Oh, that's painful.
If we connect this to the bigger picture, this is exactly why you cannot just automate this process with a generic robo-advisor.
Right, because the algorithm doesn't know.
Exactly. Algorithms are built to buy index funds and rebalance portfolios. They are entirely blind to your Medicare premium tiers and your NIT thresholds.
Okay, so you need a human. And the guide also points out you need to hit the brakes on conversions if you are utilizing qualified charitable distributions, QCDs, right?
Yeah. For the philanthropically inclined, QCDs are just one of the most powerful tools in the entire tax code.
Really? How so?
Well, once you hit age 70 and a half, you can donate up to $105,000 a year directly from your traditional IRA to a qualified charity.
And the brilliant part of a QCD is that the money completely bypasses your tax return, doesn't it?
Yes, it does. It counts towards satisfying your RMD requirement, but it never shows up in your MGI.
It's like a true phantom withdrawal.
Exactly. If you plan to give, say, $100,000 to your alma mater or a favorite charity anyway, using a QCD is just a mathematical slam dunk.
Right.
And if you are employing that tool, you certainly don't want to waste your 24% tax bracket space converting that specific $100,000 to a Roth.
Because the charity is going to receive it tax-free regardless of whether it's pre-tax or post-tax money.
Precisely. You'd just be paying taxes for no reason.
Wow. Okay, so there's another massive trap the guide brings up, and it makes total sense given that Davies Wealth Management operates out of Stuart, Florida.
The domicile factor.
We have to talk about the state tax domicile factor. Geography changes the math fundamentally here, doesn't it?
It really does. Florida has zero state income tax.
Right.
If you are executing these Roth conversions while still living in a high-tax state like California, New York, or New Jersey, you aren't just paying the federal 24%.
Oh, man.
You are layering an 8, 9, or even 10% state tax right on top of it.
So if you are a highly compensated executive planning to retire and move to Florida at age 65, doing a massive Roth conversion at 63 while you are still like a New York resident is a colossal unforced error. You just handed the state of New York 10% of your retirement principal for absolutely no reason.
Which perfectly underscores the necessity of a highly calibrated multi-year plan. I mean, a fee-based fiduciary isn't just looking at the federal tax bracket.
They're looking at everything.
Right. They are timing your conversions with your relocation timeline, your charitable giving goals, and your healthcare costs. It really requires looking at the entire chessboard.
And, the implications of mapping all this out don't actually stop when you pass away.
No, they don't.
This is the part of the guide that completely reframes the concept for me. We are moving beyond your own retirement security here and looking at, well, what they call the ultimate legacy flex.
Yeah.
Because the Secure 2.0 Act totally rewrote the rules for inherited wealth.
It fundamentally altered the landscape of estate planning.
How so?
Well, under the old rules, if you left a $2 million traditional IRA to your children, they could stretch those required distributions over their entire lifetime.
Okay, so they just take a little bit at a time.
Right. They could take tiny slivers out every year based on their own life expectancy, keeping the tax impact totally negligible.
Which sounds great.
It was great. But the IRS realized they were waiting way too long for their money. So Secure 2.0 eliminated the stretch.
Oh, wow.
Now, non-spouse heirs, like your adult children, must completely empty that inherited IRA within exactly 10 years.
So what does this all mean? Think about the timing on that. You pass away in your 80s, which means your kids are likely in their 50s, right? They are in their absolute peak earning years, and suddenly they have a ticking 10-year clock to drain a $2 million account.
It's a huge burden.
They are forced to pull out hundreds of thousands of dollars a year, stacking it directly on top of their own high salaries. They're getting crushed by the highest ordinary income tax rates.
You're essentially bequeathing them a massive tax bomb during the most expensive decade of their lives.
That's awful.
But consider the alternative. What if you had utilized that 62 to 72 income valley to systematically convert those funds into a Roth IRA instead?
Well, wait, they still have to empty the Roth in 10 years, right? That specific 10-year depletion rule didn't change, did it?
The 10-year clock absolutely still applies.
Okay.
But because it is a Roth IRA, every single withdrawal they take over that decade is completely tax-free.
Oh.
Yeah. They get 10 years of tax-free compounding growth in the market, and they pull the capital out without handing a single dime back to the IRS.
That is massive. And this plays directly into the current legislative landscape, too. The guide touches on the July 2025 One Big Beautiful Bill Act.
Yes.
Mathematically, it locks the federal estate tax exemption at, what, $15 million per individual?
Right, which is a profound paradigm shift for high net worth families.
Mm-hmm.
With an exemption that's $30 million for a married couple.
That's huge.
It is. It means the federal estate tax itself is no longer the primary threat for the vast majority of affluent retirees.
So the battlefield has completely shifted.
Completely.
You don't have to panic about the tax on the total physical value of your estate when you die. The real threat to your family's wealth is the income tax burden you are leaving behind on those pre-tax accounts.
Exactly. The Roth conversion ladder is the ultimate tax prepayment gift.
Right.
You are deliberately paying taxes in your 60s at 24%, so your children don't have to pay taxes in their 50s at 37% or 40%.
Wow.
It is a remarkably elegant strategy that sits right at the intersection of your own retirement security and your family's multi-generational legacy.
And the numbers the Davies Wealth Management material puts on this are just staggering.
They really are.
For a typical high net worth family, utilizing this 10-year use it or lose it window properly can save anywhere from $200,000 to $500,000 in lifetime taxes.
$500,000.
$500,000. Just by understanding the mechanics of the game and playing your Tetris blocks perfectly before age 73.
It is undoubtedly the most valuable decade in financial planning.
Hey.
Yet, honestly, it remains the most consistently wasted.
Why do you think that is?
Because the default human assumption is that doing nothing is the safest route. But in decumulation, doing nothing is actually the most expensive choice you can make.
So true. Since you are approaching this exact window, or, maybe you're already in it, you simply cannot afford to assume your tax burden will naturally shrink on its own.
Right.
The source for today's deep dive, again, is Davies Wealth Management and their 1715 Treasure Coast Financial Wellness material. They actually have a free resource mentioned in the text tailored specifically to these tripwires.
Oh, yes, the IRMAA guide?
Yeah, it's called the Medicare IRAA Planning Guide. It helps you map out exactly how your retirement income will impact those stealth premiums and how to start structuring these conversions to protect your wealth.
Because mapping the numbers to your specific reality is really the only way to build a defense that actually works.
Absolutely. But before we wrap up, I want to leave you with one final thought to chew on.
Okay.
If the government is fully aware that this massive income valley loophole exists for the wealthy, and they absolutely are, right?
Oh, for sure.
And with the national debt continuing to skyrocket, how long until legislative changes target Roth conversions directly? Are we looking at a fleeting golden window that future generations simply won't even have access to?
That's the million-dollar question.
Yeah.
I mean, tax codes are always written in pencil. The landscape can and likely will shift again.
The rules could change tomorrow, but for today, the window is wide open. So don't be the person who successfully navigates 40 years of the career marathon, only to cross the finish line and find yourself parked in the most expensive traffic jam of your life.
Build your exit ramp before you need it.
Well said. Thanks for joining us on this deep dive. We'll see you next time.